Hello and welcome to everyone who's joining us for this online presentation today, an information session developed directly for you to give you some ideas and tips in relation to preparing for retirement. Taking the guesswork out of planning for your retirement is a big topic. So we've got a number of case studies and ideas for you to explore during our session today. And as always, we have our disclaimer. So the advice that I'm giving you here, and particularly given that we're going through a case study, is for illustrative purposes. It is not a situation that is directly related to yourself, but it might have elements that are. So by all means, listen. This is not directly advice to you. This is general in nature, but it is designed to try to pique your interest and to try to let you know some of the strategies and some of the things that you need to think about as you are preparing for your retirement. So some of our learning outcomes. So ultimately, I just want you to be able to understand some of these pre-retirement strategies, understanding some of the Centrelink opportunities that may present themselves, in particular where you've got spouses of differing age groups. Even if it's only 2 years difference, it can actually expose some opportunities on the Centrelink front. Understanding how the different strategies interact. So one of the things that makes this really fun is the idea of stacking strategies on top of strategies in order to get you the best outcome. And I guess ultimately what I'm trying to get across in this information session is to really help you to understand the difference between financial planning and investment advice. A lot of people think of financial planning and they just think it's all about telling you where to invest your money. And sure, that's part of it. But the way we think about financial planning, certainly our ethos is that it's strategy first, investment second. The strategies, and what I'll show you here today, is the strategies that can really move the needle a lot in relation to what you can achieve, but also in your understanding of what is possible for you in your retirement. So we think that that's where you should always be starting with any of your pre-retirement strategies or even retirement strategies. But it's all a part of it. So what I'm going to take you through today is one case study. And you can see on the slide there, we've got Bruce and Demi. And through their situation, I'm going to explore essentially 8 different potential strategies. Now, not all of these will apply to you. And in fact, I haven't by all means included any and all strategies that are possible, but they're just to illustrate to you what is possible and how a financial planning approach where we're looking at things holistically, we're looking at the tax rules, we're looking at the superannuation rules, we're looking at Centrelink rules, we're trying to understand your cash flow, what your loan situations are. There's all this myriad of variables that we're trying to boil into a pot to actually work out, well, what are the strategies that are going to apply to you that will get you the best outcome and get best traction for you in your circumstances. So let's talk about the case study very quickly. So we've got Bruce and Demi, and you can see there that Bruce and Demi have got about 6.5 years difference between them. That's going to become more relevant, and you'll see the impact of that down the track. Bruce is about to retire. Demi has still been working or will be continuing to work for a period of time, but she's looking to retire. So this is their pre-retirement strategy. They own their home. Yes, they've got a small amount of debt on that, but they've got some money sitting in an offset. So they're effectively debt-free. They've got some good balances in super, particularly with Demi with 1.25 mil. And Bruce actually owns a 1/3 share of a commercial property that he inherited with his siblings. So once again, some of these key elements are things that will come out as we go through the case study. So bottom line is here, they've got net assets of about $3.6 million, but they've got net assets excluding their home and lifestyle assets. And that's the number that we tend to focus on a little bit more, because you can't feed your family off your house. Yes, you don't have to pay rent and all that sort of stuff, but it's your investable assets at the end of the day that are going to then create the lifestyle and the cash flows that you need to be able to retire with and give you that retirement comfort and security. So the 1.83 mil is their non-lifestyle asset base. So that's what we're going to be focusing on throughout this case study. So as I mentioned, Demi has been working, Bruce has been retired for a while now. She's planning to finish work on the 10th of June, 2023. Now, doesn't matter which year, but let's say this is the year just gone. Demi wanted to take her long service leave and annual leave as a lump sum prior to 30 June. She also wanted to use lump sums to pay some super contributions. She wants to pay off the home loan, make some super contributions for Bruce out of some of the excess cash flow that they would have, and then start pensions for both of them out of their superannuation funds so that they could actually fund their retirement income streams. They would then, because Bruce is over 67, they'd be eligible and would apply for the Senior Australians Healthcare Card for him. And they would certainly get the low income healthcare card for her once she's actually through a period of time after she's finished her employment. So that's what she comes to. That's their plan that they've come up with. Now, let me be really clear. This is what they have come to us with. This is not necessarily the best or most effective way to do it. So where we first start is by talking about these things in advance of the date that you are planning to retire, because there are things that we can talk about the timing of your retirement that can be really quite critical. So let's look at strategy 1, for example. So first of all, we would suggest that Demi do not take her long service leave and her annual leave as a lump sum. She should have it paid over June or July rather than all in June, purely because the tax implications are far better by having it in the next financial year where she's not already on the top marginal tax rate. In addition to that, if she simply continues to take her annual leave and long service leave rather than taking it as a lump sum, her employer will actually have to pay superannuation guarantee at 11% on those payments to her. Whereas if she takes it as a lump sum, there's no requirement for them to pay superannuation on the lump sum payment. So by simply doing that alone, we may have increased how much is going into super for Demi by about $2,500, and there's tax savings of about $5,800 just purely by looking at that one little element and getting the timing just a little bit different than what their original plan was. So that's a really good start, and what you can start seeing, and one of the things we like to be able to do is look at the strategy, quantify what the benefits are to you, also any risks or downsides of it. But it's really important for us to quantify where the potential tax or superannuation or whatever savings are along the way. Helps us to then prioritise the things that we should do. Okay, so the next one, strategy 2, is actually what contributions to make and when. So we would suggest to Bruce as a non-concessional contribution, but also make some personal contributions for Demi with the rest of the cash flow that's there, purely because we're going to be able to get some extra tax deductions for Demi in a year where her income is a lot higher than what it will be down the track. So there's going to be a lot better tax outcome that you can get that way. We can also treat some of Bruce's contribution as a spouse contribution to Demi and maybe offset some of the taxes he might otherwise be paying on the rent that he's receiving from his commercial property. The other thing, and I've mentioned here reserving strategies. Now, reserving strategies are only available in a self-managed fund environment. But that's another way that we can accelerate how much we get as a tax deduction in the final year of your work life, if you like, where a self-managed fund makes sense to you. So that won't be the case all the time, but it's something to consider. Once again, what are the benefits? Well, we're talking personal tax savings just with those modifications of potentially $10,500. That's a one-off, of course. The fund, sure, it pays an extra $4,350 worth of tax, but there's a net tax saving of over $6,000 in that particular example. We also may have them being eligible for the spouse contribution of rebate, which is another $500. So once again, quantifying all these benefits and what have you all along the way so that we can prioritise where the benefits and the advantages are. One of their strategies that they wanted to do was to pay off their home loan. Now, this is something where it really is a very personal thing, whether or not you pay off your home loan, because there are other alternatives. There could be leaving $1,000, $2,000 on that home loan balance in order for you to be able to have the ability to redraw that at a later point in time. You never know when you might need some emergency funds. So being able to have that home loan still alive can in some instances be really important, but it might be that you would prefer just to be debt-free. So once again, very personal, and it's all about your peace of mind. But these are things that are worth talking about, particularly now that interest rates are a lot higher. Having the home loan there could be more costly than what you're prepared to wear. But if the balance that's outstanding is only $1,000 or something fairly tokenary, then the cost is fairly minimal. So it's all about the way up between the cost and the peace of mind that having those monies available to redraw may give you. So strategy 3, have a think about what you do with the home loan. Strategy 4, in specie transfer of assets. Now, in specie is basically a fairly technical term, but it basically means that instead of making a contribution in the form of cash into superannuation, you're making a contribution using assets. Now, those assets could be direct shares that you have in your own portfolio, for example, or it could be, in this instance, we've got the property that he inherited, that Bruce inherited from his parents. He's got a 1/3 share of that property. It might be that we want to have a think about whether we transfer that into superannuation instead of it being in his own name and then him being taxed on the income of that property long term. So some things we need to really think about before we start going down this rabbit hole is we need to think about the capital gains tax implications of this. We need to think about what the stamp duty costs may be. Is there any land tax benefits or disadvantages? Are there any encumbrances on the property? Has one of the other siblings used that property as security for a loan? Any of these things could mean that we are not able to do that, but it's worth exploring. Because Bruce inherited this property, we know that there are actually going to be some fairly significant capital gains tax implications of selling that property into the super fund, because as you're making an in specie transfer of the property to super, that's essentially what you're doing, is you're actually selling it to the super fund. It's just that you're not paying cash for it. So you still have to treat it as though it is a sale by Bruce and that the super fund is purchasing that asset. So it's still 2 separate transactions, even though it's all happening in one go. Now, because he's got some capital gains then on that transaction, we have the potential, because remember that Bruce has been retired for some time, he hasn't made super contributions that he's claimed a tax deduction for several years. So there may be an opportunity for us to use what they call the catch-up contribution rules in order to offset any of the capital gain made on the sale of that property. So in this particular example, the value of us moving the property could be that once we turn the pensions on for Bruce, and Demi, of course, then the rent received would be able to be taxed at a 0 tax rate inside the superannuation fund. Whereas outside the fund, he's paying tax at his marginal tax rate. The second thing is that future capital gains on that property will be capped at a maximum in the super fund of 10%, but it could be as little as 0% once again, depending on when you sell it down the track. So once again, interesting nuance from the perspective of, okay, well, what do we want and how much tax are we going to pay in order to get these benefits? And it's about making that cost-benefit analysis. There could also be the potential to increase the amount of age pension that you're eligible for by thinking about whose name that property goes into the super fund on behalf of. So we'll talk about the Centrelink elements a little bit later, but these are some of the things that we can think about. Strategy 5, pension and Centrelink. And I know that when we talk about pensions, normally we think about Centrelink benefits, but in the superannuation world, there is a pension that is actually going to be generated from your own superannuation monies. That's what we call a pension. The Centrelink aged pension is what you get from the government. So basically, one of the potential strategies for Demi and Bruce is to not start a pension from Demi's part of the superannuation fund, but instead claim the aged pension for Bruce. Because he is age 67, or he was about to be, he is now eligible to get an aged pension, but you have to satisfy the incomes and the assets test. Now, whilst Demi was working, there was no way they were ever going to satisfy the incomes test. So that wasn't really an option. But now that she's retired and they don't have that income coming in, the only other things that you get tested on, if you like, is the pensions that are started for both of them or either of them, and any other income that he's got coming in. So in this instance, he's going to have his property income being assessed against his incomes test. He's also going to have any pension that he has started going against his incomes test. But if Demi doesn't take her pension, then her superannuation and any pension that she may have been eligible for doesn't count towards the assets test. So that may mean that Bruce becomes eligible for some, maybe full pension or a part pension, for the period of time until such time that Demi reaches the age of 67. And then as soon as she turns 67, then all of her assets, even though they're in super, will then count towards the assets test, and then they would probably not be eligible at all. But there is a 7-year period here where they may actually be able to get some of the age pension, whereas otherwise they wouldn't. So in this instance, there is a tax saving inside the fund of about $1,500. There's age pension that Bruce is able to be eligible for of about $9,000 per year. Now, that would actually ramp up as the years go by, as his balance reduces. There's age pension benefits for Bruce of, we estimate those to be about $2,000. Things like discounts on your car rego, discounts on your council rates, things like that. But on the opposite side, there's also less benefit, tax benefit inside the fund, because Demi's account inside the fund is actually going to be still in accumulation mode, which means you're essentially paying tax on the earnings on her part of the fund. So overall, the net benefit, when you look at all of those things in this particular instance, over the 7 years is about $20,000. It could be a little bit better than that, but that's still a pretty good estimate. So once again, quantifying these things so that we can weigh up whether it's worthwhile and what combination of these strategies we might adopt. Strategy 6, benefit and recontribution strategies. These are basically where we're looking to essentially recategorize the current taxable elements of your superannuation benefit. Essentially, by taking money out of the fund and then putting it back in again. It's kind of like laundering money in a legal, completely legal way, but it's very much like that. You literally take the money out, put it back in, take it out, put it back in, under certain limits. Like we still have to satisfy the contribution rules and have to be able to take the money out. But because you're over 60, you can take money out of super without any tax implications. But if there is any of your superannuation left at the end of your life, and it goes to your spouse, then there's no tax. But if it goes down to the next generation, to your adult children, then they will have to pay tax at about 17% on whatever the taxable elements are within your superannuation components. So basically, by doing this washing of the money, it doesn't make any difference to you, really, but it could save your children, your adult beneficiaries, if you like, hundreds of thousands of dollars. In this particular example, by doing this structured recontribution strategy, we're basically saving the adult children about $112,000 in potential estate tax or death taxes, if you like. The other thing that it does do is we're always worried about the government's need to raise taxes on superannuation, and whether there could be a time in the future where they basically say, well, just because you're over 60 doesn't mean that it's all tax-free. If they were to change those rules so that that tax-free rule, if you like, if you're over 60, is removed at a later point in time, then at least by you having higher levels of tax-free components means that any change of that nature is not really going to affect you too much. So it's essentially future-proofing you against future potential changes in the laws. So you're getting a bit of a double whammy effect, but really the main benefit will be to your adult children. Strategy 7 is where we want to talk about the Centrelink a little bit more. So basically, the concept is being able to manipulate whose name the assets are in inside the superannuation, and also what assets are in superannuation, and understanding how that links back to what gets assessed for Centrelink purposes and what doesn't, and at what times. Because as I said to you earlier, there's 2 tests that Centrelink will use to establish your eligibility. One is the incomes test and one is the assets test. So here what we're doing is we're really thinking strategically about what assets we want inside that accessibility bubble and what ones we don't. And we can actually manipulate that to a fair degree by simply making sure that we've got the younger partner, in this case it's Demi, has more of the retirement assets in her name, and Bruce has more minimal ones in his name because it's only his that potentially could get assessed against the assets test, and therefore by default the incomes test as well. So it's really just about strategically thinking our way through that. So the benefits, of course, is we can manipulate the eligibility for Centrelink, and we can actually also have Bruce's superannuation account now being 100% tax-free for later planning purposes. This, by manipulating this even further, what we've got the ability to do is basically have the net benefit being about $6,600 per year. And as I said to you, it's probably for the next 6.5 to 7 years. So these types of benefits can actually add up quite a bit over time. Strategy 8, future planning. So once again, this is where we've taken what I was talking about earlier in relation to the benefit and contribution strategy, but it's really, in a fashion, it's sort of putting it on steroids, because what we're doing is we're not just doing it once. What we're doing is we're planning to actually activate that strategy again in 3 years' time. The only thing that limits us with this benefit and recontribution strategy really is the fact that there are contribution rules that limit how much we can actually make as a non-concessional contribution every year. A non-concessional contribution is basically where you're giving your own money and you're not claiming a tax deduction for that contribution being made to superannuation. And that limit is basically $110,000 per person per year, or, and that's right up to the age of 75, or you can bring forward basically 3 years worth of that limit and do it all in one hit. So essentially we've got $330,000 that we can do in one go, but then that's it for the next couple of years. And then we look forward, and in 3 years' time, we might look to do that again. Now, in order to really do this as effectively as possible, what it also incorporates is us basically having what we call a multiple pension strategy or multiple account strategy. What that basically means is that we do the recycling, but then what we're trying to do is we're trying to keep those new components that are all tax-free inside the super fund, keep those separate from what the old components were that might have a mix of tax-free but probably mostly taxable components, because in the majority of instances that's being contributed to by your employer or by you claiming tax deductions over the years, which means that its categorisation is taxable. So essentially what you want to do is keep those two things separate. The way we keep those separate is by basically having the new money going into a new pension account and have that be, I'll call it, counted for separately. So once again, it's really just about being strategic and thinking ahead, because in this instance, we've got Demi who's 60. So we've got 15 years that we can continue to do this sort of planning for Demi. And for Bruce, he's 67. So we've got at least another 8 years up until age 75 where we can sort of continually do this recycling of the money to basically get the best outcome from an estate planning perspective. So if we look ahead over the next 5 years, we could essentially convert about $1.2 million worth of their superannuation balances into these tax-free components, but you can't do it all in one hit. It is going to take a continual review and actions every 3 years or so. Therefore, the overall tax savings to the adult children potentially on the death of both Demi and Bruce could be as much as $165,000. Once again, these are all numbers that really add up when the time comes. And if it's not costing you any tax in order to do this, then it's almost a bit silly to ignore it. So, as I said to you, really interesting case study. Not all of it will apply to you, but it's a really interesting one purely from the perspective of opening your mind up to some of these strategies that we can adopt and incorporate into your plan. And you'll notice that none of these things have had anything to do with investments. Interestingly, though, when you start looking at summing up the total of the value, if you like, that we've been able to quantify out of these various strategies, in this particular instance, we've got a grand total of about $320,000 worth of essentially benefits that are quantifiable, either tax benefits or Centrelink benefits netted off against, what the costs might be. Now, $320,000, remember that we were looking at an asset base of about $1.8 million. That actually represents about 7% over that 5-year or 7-year period. So at least 1% per annum that we've been able to eke out in relation to benefits purely by looking at the strategy. Now, I know that there's some investment advisors out there who can tell you that they can do wonderful things with your investment returns, but this has actually got nothing to do with risk or anything. This is just about being really clever with your strategies and thinking about all the different elements that we can bring together to get you the best result. So, opportunities. What can we think about and what are some of the things that we've talked about just to sum up? So once again, getting strategic advice about your retirement is always best to be done before you retire. Then we can talk about things like the timing of your retirement date, timing of different contribution strategies that we might want to adopt, strategies in relation to Centrelink. It might be that that's a few years away for you, but you need to be thinking about these things. And I know as well that the rules are seeming to be changing all the time, but that doesn't mean that we can't be doing things now with a view to having some sort of Centrelink strategy that we might launch into in 2 or 3 years' time when you become eligible. Benefit and recontribution strategies is definitely something that's on the cards for everyone. And now that they've changed the rules that you can actually make contributions to super funds right up to the age of 75, particularly the non-concessional contributions, so they're the ones that you don't claim a tax deduction for, they're the ones that we use in these benefit and recontribution strategies. Because they've extended that up to age 75, it used to be up until 67 and then you had to satisfy a work test. You don't have to now. That means that right up until age 75, we need to be looking actively at these benefit and recontribution strategies for you. And then finally, multiple pension accounts. It sounds onerous. It doesn't have to be. But if that gives you a much better strategy platform, then generally speaking, it's worth it. So we certainly use a lot of those. If you've got a self-managed fund, it's a lot easier to do those multiple pension strategies, but you can actually still do the same sort of thing with, there's lots of platforms that we use for superannuation accounts where they have what they call a family discount that we can apply, so that even though you've got multiple accounts, you might have a superannuation account and 2 pension accounts, for example, the fees for the platform or for the super fund get calculated as though you've got one balance. So you're not doubling and tripling up on your platform fees just because we're wanting to do these types of strategies. So there are some really good ways that we can do it and still make it practical to achieve what we want to. How can we help? Well, I think we've talked a little bit about the difference between financial advice and investment advice. And that's not to say that there is anything wrong with people who specialise in the investment advice, but our philosophy is, yes, you need to do that well, and I feel that we do, but the strategy at the front end is actually super important. Don't ignore that part. If you've got any questions, please send them through to the email addresses on the slide there. But you've also got access to the presentation materials. We'll send you out an invitation to re-watch this video so that you can go over it again. It's always good to hear these things more than once often. If you're interested, or if there's some particular element that you're interested in, please feel free to reach out. We have the ability to have a complimentary meeting with one of our team. But absolutely, you should be becoming a part of our Money Smart program and being part of that community where we're getting you information and resources like this as we're going along. Follow us on social media as well, by all means, because we have articles and blogs and things coming through there as well. So that's it for me. The team here is we all have different specializations. We have a special team that just deals with superannuation, but our financial planning team are all full of people that are actually really qualified and highly skilled in a lot of these strategies we've talked about today. So you will be in absolutely good hands. And I look forward to talking to you soon.